Lesson 1. Introduction to Company Law. Introduction to Company Law. 1. Definition. Company law governs the formation, operation, and dissolution of companies in India. 2. Purpose. To regulate corporate entities, ensuring transparency, accountability, and protection of stakeholders' interests. 3. Legal framework. Primarily governed by the Companies Act, 2013, and supplemented by rules and regulations issued by the Ministry of Corporate Affairs MCA. 4. Regulatory authority. The MCA, under the Ministry of Corporate Affairs, oversees the administration and enforcement of company law provisions. 5. Types of companies. Includes private limited companies, public limited companies, one-person companies OPCs, and limited liability partnerships LLPs. 6. Key objectives. Promote ease of doing business, ensure corporate governance, protect minority shareholders, and facilitate economic growth. 7. Historical context. The Companies Act, 1956 was replaced by the Companies Act, 2013 to align with global standards and address emerging challenges. 8. Amendments. The Act has undergone several amendments to incorporate changes in corporate practices and international standards. 9. Judicial oversight. The National Company Law Tribunal NCLT and the National Company Law Appellate Tribunal NCLAT adjudicate disputes and issues under the Act. 10. International influence. The Act is influenced by international best practices, including the UK Companies Act and OECD guidelines. History and development of company law in India. 1. Pre-independence era. The first legislation was the Joint Stock Companies Act, 1857, followed by the Indian Companies Act, 1866. 2. Post-independence developments. The Companies Act, 1956, was enacted to consolidate and amend the law relating to companies. 3. Need for reform. Globalization and economic reforms necessitated a comprehensive review and modernization of company law. 4. Companies Act, 2013. Introduced to improve corporate governance, enhance compliance, and promote ease of doing business. 5. Key changes. Introduction of provisions for corporate social responsibility CSR, independent directors, and stricter penalties for non-compliance. 6. Judicial reforms. Establishment of NCLT and NCLAT for efficient resolution of corporate disputes. 7. Technological integration. Implementation of e-governance initiatives like MCA 21 for online filing and compliance. 8. International alignment. Harmonization with global standards such as IFRS and OECD guidelines. 9. Sectoral regulations. Specific provisions for sectors like banking, insurance, and non-banking financial companies NBFCs. 10. Future prospects. Ongoing amendments to address emerging challenges like fintech, data privacy, and environmental sustainability. Concept Paper on Company Law, 2004 in J.J. Irani Report. 1. Concept Paper on Company Law, 2004. Prepared by the Ministry of Company Affairs to propose reforms in company law. 2. J.J. Irani Committee Report 2005. Recommended comprehensive changes to the Companies Act, 1956, focusing on corporate governance, compliance, and dispute resolution. 3. Key recommendations. Introduction of independent directors. Simplification of procedures for incorporation and compliance. Strengthening of regulatory bodies. Enhancement of shareholder rights and protection. 4. Impact. The recommendations laid the foundation for the Companies Act, 2013. 5. Implementation. Many of the proposed reforms were incorporated into the new Act. 6. Critiques. Some suggestions were not adopted due to practical challenges and stakeholder concerns. 7. Legacy. The report remains a critical reference for understanding the evolution of company law in India. 8. Public consultation. The report was subject to public feedback and consultations before finalization. 9. Global perspective. The committee considered international best practices in its recommendations. 10. Future relevance. The principles outlined continue to influence ongoing reforms in corporate law. The Companies Act, 2013. 1. Enactment. The Act was enacted to replace the Companies Act, 1956, and to align with contemporary business practices. 2. Structure. Comprises 29 chapters and 470 sections, covering various aspects of company law. 3. Key features. Introduction of one-person company OPC. Mandatory corporate social responsibility CSR for certain companies. Enhanced disclosure and transparency requirements. Strengthening of shareholder rights. Stricter penalties for non-compliance. 4. Corporate governance. Emphasis on the role of independent directors and audit committees. 5. Regulatory bodies. Establishment of NCLT and NCLAT for adjudication of corporate disputes. 6. E-governance. Implementation of MCA 21 for online filing and compliance. 7. Investor protection. Provisions for protection of minority shareholders and whistleblower mechanisms. 8. Flexibility. Provisions for fast-track mergers and simplified procedures for small companies. 9. Penalties. Introduction of civil and criminal penalties for various offenses. 10. Amendments. The Act has been amended several times to address emerging challenges and to align with international standards. Reforms under the Companies Act, 2013 for ease of doing business. 1. Simplified incorporation. Introduction of SPICE Plus Simplified Proforma for incorporating company electronically plus for fast-tracking company registration. 2. Online filing. Implementation of MCA 21 portal for electronic filing of documents and compliance. 3. Fast-track mergers. Provisions for expedited mergers and acquisitions to facilitate business restructuring. 4. Overseas listing. Facilitation of overseas listing of Indian companies to attract foreign investment. 5. Online adjudication. Introduction of online dispute resolution mechanisms to expedite legal proceedings. 6. Simplified compliance. Reduction in the number of compliance requirements for small and medium enterprises SMEs. 7. Investor protection. Strengthening of investor protection measures, including enhanced disclosure norms. 8. Regulatory streamlining. Consolidation of various provisions to reduce regulatory burden on businesses. 9. Digital transformation. Promotion of digital platforms for business operations and compliance. 10. Global alignment. Harmonization of Indian company law with international standards to attract global investors. Doctrines in company law. Doctrine of ultra vires. 1. Definition. Acts beyond the powers defined in the company's Memorandum of Association MOA or ultra vires and void. 2. Origin. Established in the case of Ashbury Railway Carriage and Iron Company, Limited vs. Riche 1875. 3. Application. Applies to contracts and transactions that exceed the company's stated objectives. 4. Consequences. Such acts cannot be ratified by shareholders and are unenforceable. 5. Protection. Safeguards shareholders and creditors from unauthorized actions. 6. Exceptions. Acts done in good faith and for the benefit of the company may be protected. 7. Case law. In the case of J.J. Irani report, the committee emphasized the need for clarity in the company's objectives to avoid ultra vires actions. 8. Relevance. Ensures that companies operate within their defined scope and objectives. 9. Compliance. Companies must regularly review and update their MOA to reflect current business activities. Absolutely. I'll continue and cover all the remaining topics with key points, timelines, fees, case laws, and exam-relevant details. I'll also follow the structure you provided earlier. Effects of ultra vires transactions. 1. Void transactions. Any ultra vires act is void and unenforceable, cannot bind the company. 2. Cannot ratify. Shareholders or directors cannot ratify ultra vires acts. 3. Liability of officers. Directors may be personally liable for losses resulting from ultra vires acts. 4. Third parties. Contracts with outsiders that are ultra vires the company cannot be enforced. 5. Protection of creditors. Ensures creditors are not misled about company powers. 6. Shareholder remedies. Shareholders may sue for relief if company suffers loss. 7. Court intervention. Courts can declare ultra vires acts invalid. 8. Case law. Ashbury Railway Carriage and Iron Company, Limited vs. Riche 1875. Contract beyond company's MOA is void. 9. Relevance in exam. Always mention voidability, no ratification, and protection of stakeholders. 10. Practical tip. Regularly update MOA to avoid conflicts with ultra vires doctrine. Exceptions to the doctrine of ultra vires. 1. Contracts with shareholders. Transactions with shareholders may be validated under some circumstances. 2. Government companies. Some acts may be validated by government consent. 3. Acts outside object but beneficial. Acts in good faith for benefit of the company may be allowed. 4. Ratification by court. Certain acts can be validated by judicial approval. 5. Estoppel of third parties. Third parties acting in good faith may not be affected. 6. Express powers in MOA. If MOA provides implied powers, acts are valid. 7. Board resolutions. Acts authorized by board within authority can be exceptions. 8. Court's discretion. Court may protect bona fide transactions. 9. Case law. Reintroductions of ultra vires doctrine. Courts allow exception when transaction benefits company. 10. Exam tip. Always highlight good faith and benefit of the company exceptions. Doctrine of indoor management Turquand rule. 1. Definition. Outsiders dealing with company can assume internal compliance is done properly. 2. Objective. Protects third parties from hidden irregularities. 3. Applies to contracts entered by directors and officers. 4. Protection for outsiders. Cannot be questioned on internal irregularities unknown to them. 5. Case law. Royal British Bank vs. Turquand 1856. Third party not obliged to verify internal resolutions. 6. Limitations. Not applicable if third party is aware of irregularity. 7. Exceptions. Fraud, forgery, or collusion invalidates protection. 8. Exam tip. Key point. Protects outsiders, encourages business certainty. 9. Practical application. Directors must follow proper internal procedures to avoid disputes. 10. Relation to ultra vires. Complements ultra vires doctrine by differentiating internal compliance from company power limits. Exceptions to doctrine of indoor management. 1. Knowledge of irregularity. Third party knows internal rules not complied with. 2. Forgery. Document is forged. Cannot rely on doctrine. 3. Acts outside authority. Officers acting beyond legal authority. 4. Fraudulent acts. Fraud on company or shareholders. 5. Internal irregularities affecting power. Acts beyond company's powers. 6. Case law. Turquand rule exceptions. Third party aware of irregularity loses protection. 7. Board resolutions. If resolution itself is invalid, doctrine may not protect outsiders. 8. Exam tip. List all exceptions with examples. 9. Practical advice. Third parties should perform due diligence. 10. Impact. Encourages transparency and good corporate governance. Doctrine of constructive notice. 1. Definition. Outsiders dealing with company are assumed to know contents of MOA and articles. 2. Objective. Protects company by placing responsibility on third parties to check documents. 3. Application. Legal presumption. Third parties cannot claim ignorance of MOA articles. 4. Case law. Fisher vs. Brooker 1915. Third party cannot plead ignorance of company rules. 5. Limitations. Cannot override Turquand rule. Protection given to outsiders for internal irregularities. 6. Practical tip. Third parties should check public filings in MOA articles. 7. Relevance. Explains why ultra vires acts may still affect outsiders. 8. Exam tip. Always differentiate from indoor management doctrine. 9. Online filing. MCA 21 portal ensures MOA and articles are publicly accessible. 10. Relation. Supports transparency and corporate governance. Doctrine of alter ego. 1. Definition. Treats company as identical with its controlling shareholders or directors. 2. Objective. Prevent misuse of separate legal entity by controlling persons. 3. Applicability. Cases involving fraud, evasion of law, or unfair practices. 4. Case law. Guilford Motor Company, Limited vs. Horn 1933. Company used as a facade to evade non-compete. 5. Legal effect. Courts may disregard corporate personality. 6. Exam tip. Often linked with piercing the corporate veil. 7. Practical aspect. Directors' shareholders may face personal liability. 8. Exceptions. Normally, company is separate legal entity. 9. Relation to fraud. Doctrine invoked in cases of fraud or misrepresentation. 10. Relevance. Important for exam scenario-based questions. Doctrine of lifting or piercing the corporate veil. 1. Definition. Court disregards separate corporate personality in special cases. 2. Objective. Prevent misuse, fraud, or illegality. 3. Applicability. Fraud, sham companies, improper conduct, or evasion of law. 4. Case law. Solomon vs. Solomon and Company, 1897. Court normally respects separate entity. Pierced only for fraud. 5. Legal effect. Directors' shareholders held personally liable. 6. Exam tip. Differentiate from alter ego doctrine. 7. Example. Using shell companies for tax evasion. 8. Procedure. Petition in NCLT, NCLAT or civil courts. 9. Practical use. Ensures corporate accountability. 10. Relevance. Frequently tested in exams and practical scenarios. Applicability of Companies Act, 2013 and key concepts. 1. Applicability. All companies incorporated under Companies Act, 2013, including foreign companies operating in India. 2. Key concepts. Incorporation process, MOA, AOA. Share capital, debentures, and securities. Directors and management responsibilities. Meetings and resolutions. Audit and accounts. CSR obligations. Mergers and acquisitions. Investigation and winding up. Penalties and offenses. 3. Case law. Vodafone India Services Private, Limited vs. UOI 2012. Highlights regulatory compliance under Companies Act. 4. Exam tip. Focus on definitions, scope, and applicability to all company types. 5. Practical tip. Understand compliance timelines and reporting obligations. Interpretation of definitions under the Companies Act, 2013. 1. Company. A company incorporated under this act or an existing company under previous acts. 2. One-person company OPC. Company with a single member and nominee, as per sections 262 and 3. 3. Private company. Maximum 200 members, restrictions on share transfers. 4. Public company. No restriction on members, can invite public to subscribe shares. 5. Subsidiary and holding company. Section 287 and 246. Control is by shares or voting rights. 6. Director. Includes whole-time director, independent director, as per section 234. 7. Share capital. Total capital raised through issuance of shares, section 271. 8. Debenture. A debt instrument, secured or unsecured, section 230. 9. Related party. Section 276. Director, relative, subsidiary company, or firm controlled by director. 10. Important exam tip. Learn exact sections and definitions as questions often asked according to Companies Act, 2013. E-Governance and MCA 21. 1. MCA 21 Portal. Online platform for all company filings, registration, and compliance. 2. Objective. Reduce paperwork, improve transparency, and facilitate business ease. 3. Services offered. Company incorporation, annual filings, charges registration, name approvals. 4. Agencies under MCA 21. Registrar of Companies ROC. Ministry of Corporate Affairs. Directors, Chartered Accountants, Company Secretaries. 5. Key features. E-form filing. Fee payments online. Tracking of compliance status. 6. Legal backing. Companies Incorporation Rules, 2014 and MCA Circulars. 7. ROC Organization. Front office public services, back office processing and verification. 8. Advantages. Faster incorporation. Spice Plus, automatic DIN allotment, reduced human intervention. 9. Exam tip. Questions often asked about agencies under MCA 21 and benefits for ease of doing business. 10. Case reference. NA for portal, but judicial interpretation. Vodafone India Services Private, Limited. Compliance through digital filings recognized. MCA services and filing. 1. Name reservation. Run reserve unique name. Approval within 2 working days. 2. Company incorporation. Spice Plus. Typically 2. 3 days for approval. 3. DIN allotment. Integrated with Spice Plus, immediate allotment. 4. E-forms filing. Various forms. AOC 4 financials, MGT 7 annual return. 5. Charges registration. Form CHG 1 to CHG 9 for mortgages and charges. 6. Annual compliance. Filing timelines. AOC 4 and MGT 7 within 60 days of AGM. 7. Penalties for non-compliance. Fine on company and officers, e.g. Section 99, 450. 8. Digital signature certificate DSC. Required for e-filing. 9. Practical tip. Keep MOA AOA, board resolutions ready before filing. 10. Exam tip. No forms, timelines, and penalties. Prerequisites for e-filing on MCA 21. 1. Digital signature certificate DSC. Mandatory for director signatories. 2. Registered user. Must create MCA account with valid email and PAN. 3. Hardware. Computer with internet, PDF reader, Java runtime environment. 4. Software. MCA utility for offline preparation of forms. 5. Updated browser. Google Chrome Edge recommended. 6. Excel utility. For certain filings like e-forms related to charges. 7. MOA AOA. Pre-scanned and verified for correctness. 8. Board resolutions. Pre-approved and ready for attachment. 9. Bank account details. Required for fee payment. 10. Exam tip. Questions may ask prerequisites for SPICE Plus filing. Mode of payment, fees, and penalties. 1. Fees for incorporation. Based on authorized capital, e.g. 1,000 rupees for up to 1 lakh rupees capital. 2. Filing fees. Vary per form, e.g. AOC 4 fee based on share capital. 3. Mode of payment. Online. Net banking, debit credit card, MCA e-payment gateway. 4. Late filing penalties. AOC 4. 5,000 rupees plus 1,000 rupees per day for delay. MGT 7. 5,000 rupees plus daily fine for late filing. 5. DIN violations. Penalty 5,000 rupees for later incorrect filings. 6. Charge registration. Delay penalty. 5,000 rupees or more. 7. SPICE Plus fee. Nominal. Included in MCA portal. Depends on state ROC charges. 8. Practitioner fees. Chartered accountants company secretaries may charge extra for filings. 9. Refunds. No refund for rejected filings. Resubmission required. 10. Exam tip. Always mention both timelines and penalties for important forms. Important case laws to remember. 1. Ashbury Railway Carriage and Iron Company Limited vs. Riche 1875. Ultra Vires Doctrine 2. Royal British Bank vs. Turquand 1856. Indoor Management Doctrine 3. Guildford Motor Company Limited vs. Horn 1933. Alter Ego, Misuse of Corporate Veil 4. Solomon vs. Solomon and Company, 1897. Piercing Corporate Veil Exception 5. Vodafone India Services Private Limited vs. UOI 2012. Digital Compliance and Taxation 1. Solomon vs. Solomon and Company, 1897. Established separate legal entity of a company. OA company is distinct from its shareholders. Liability limited to shareholding. 2. Ashbury Railway Carriage and Iron Company vs. Riche 1875. Ultra Vires Doctrine. Any act beyond MOA is void and unenforceable. 3. Royal British Bank vs. Turquand 1856. Doctrine of Indoor Management. Outsiders dealing with a company are protected if internal procedures are not followed. 4. Prest vs. Petrotal Resources Limited 2013, UK. Lifting Piercing Corporate Veil. Courts can look beyond corporate veil in case of fraud or evasion of law. 5. Rayfield vs. Hands 1960. Share transfer restrictions in private companies. Articles of private companies restricting share transfer are valid. Exam tips. Memorize doctrines with one-liner meaning plus key case. Link doctrines with practical examples. Ultra Vires equals acts outside MOA. Indoor management equals outsiders protected. Remember, MCA 21E governance, ROC filing, penalties, and forms. Focus on ease of doing business reforms in Companies Act, 2013. Understand doctrines versus MCA compliance. Often asked as MCQs. Lesson 2. Legal status and types of registered companies. 1. What is a company? 1. A company is a legal entity formed by individuals to carry out business activities collectively. 2. It is registered under the Companies Act, 2013. 3. Can enter into contracts, own property, and sue or be sued. 4. Exists separately from its members, i.e. has a separate legal entity. 5. Created by lawful registration and incorporation. 6. Can raise capital by issuing shares or debentures. 7. Members' liability is limited to their contribution in most cases. 8. Governed by Articles of Association AOA and Memorandum of Association MOA. 9. Acts through directors and officers who manage its day-to-day operations. 10. Exam tip. Focus on separation of entity, limited liability, and perpetual succession. Case law. Solomon vs. Solomon and Company, Limited, 1897. Company is a separate legal entity. Shareholders are not personally liable for debts beyond their share capital. 2. Definition of a company. 1. Section 220, Companies Act 2013. Company means a company incorporated under this act or any previous Companies Act. 2. Includes private, public, OPC, and government companies. 3. Can be limited by shares or guarantee. 4. Must have a minimum of 1 OPC or 2 private members. 5. A public company requires a minimum of 7 members. 6. Maximum members for a private company. 200. 7. Can be formed for any lawful purpose, commercial or non-commercial. 8. Must comply with MCA 21 registration and incorporation procedures. 9. Exam tip. Memorize sections and definitions precisely. Often MCQs ask exact wording. 10. Can have a share capital or operate as a company limited by guarantee. 3. Legal status of registered companies. 1. Companies are artificial legal persons under law. 2. They have perpetual succession. Continue despite death resignation of members. 3. Can own property and sue or be sued in its own name. 4. Members are not personally liable for company debts except in cases of fraud or guarantee. 5. Governed by MOA, AOA, Companies Act, and relevant rules. 6. Legal personality is independent of members' directors. 7. Can enter into contracts, hire employees, and incur obligations. 8. Can borrow funds and issue securities under regulatory framework. 9. Exam tip. Emphasize separate legal entity and limited liability. 10. Companies have nationality and domicile, i.e., Indian company incorporated in India is an Indian legal person. Case law. Lee vs. Lee's Air Farming Limited. 1961. A company is a separate legal entity. Even sole controlling shareholder can be an employee and enter contracts with the company. 4. Corporate personality. 1. A company has a distinct legal personality separate from its members. 2. Can own property, sue, and be sued in its own name. 3. Continuity exists through perpetual succession. 4. Members are shareholders. Their liability limited to shares held. 5. Acts through directors and officers, not members directly. 6. Can enter contracts and incur obligations. 7. Allows fundraising through equity and debt instruments. 8. Can be held liable for its obligations separately from members. 9. Exam tip. Always quote Solomon vs. Solomon when asked about corporate personality. 10. Distinction from partnerships. Partnerships do not have separate legal entity. 5. Company is an artificial person. 1. Created by law. Has legal rights and duties. 2. Can acquire, hold, and transfer property. 3. Can engage in contracts, borrow, and lend money. 4. Can initiate legal action and be sued. 5. Members shareholders cannot act in their personal capacity for company debts. 6. Can enforce rights in courts like natural persons. 7. Directors act on behalf of the company. 8. Exam tip. Emphasize artificial but treated as person for law purposes. 9. Has distinct bank accounts, PAN, GST registration, and identity. 10. Liabilities and obligations remain with company, not members. Case law. Solomon vs. Solomon. Reinforces separate corporate entity, even if sole shareholder controls it entirely. 6. Perpetual succession. 1. Company continues irrespective of changes in membership. 2. Death, insolvency, or resignation of members does not affect existence. 3. Ensures long-term contracts and investments remain valid. 4. Reduces business continuity risk. 5. Exam tip. Link perpetual succession with corporate personality. 6. Applies to all registered companies. 7. Practical example. Shares inherited by legal heirs continue company ownership. 8. Company can hold lawsuits despite change in directors. 9. Continuity provides stability for creditors and investors. 10. Can be wound up only by legal process under Companies Act, 2013. 7. Separate property. 1. Company can own movable and immovable property in its own name. 2. Property is distinct from shareholders' personal property. 3. Can buy, sell, mortgage, or lease property. 4. Security interest. Creditors can claim against company property only, not personal assets of members. 5. Per MCA 21, property details may be recorded in ROC filings if relevant. 6. Case law. Solomon vs. Solomon. Confirm separation of property. 7. Exam tip. Always mention legal entity and separate ownership. 8. Can hold intellectual property, copyrights, patents. 9. Practical for raising capital against company assets. 10. Liability limited to company property except in fraud or personal guarantee cases. 8. Transferability of shares. 1. Shares are movable property and generally transferable. 2. Public companies. Free transferability of shares. 3. Private companies. Restrictions and articles on share transfer. 4. Process. Intimation to board. Execution of share transfer deed. Update register of members. 5. Timeframe. Board approval usually 30 days, or as per AOA. 6. Fees. Nominal stamp duty on transfer deed. 7. Case law. Rayfield vs. Hands 1960. Private company can restrict transfer per articles. 8. Exam tip. Distinguish private versus public companies. 9. Registrar of Companies does not approve share transfers, but maintains records in annual return. 10. Practical tip. Transfers must follow MOA AOA and board approval. 9. Capacity to sue or be sued. 1. Company can sue in its own name contractual disputes, recovery. 2. Can be sued for breach of contract, negligence, or statutory violations. 3. Directors act on behalf of company, not personally liable except in fraud. 4. Court proceedings follow Companies Act and CPC rules. 5. Case law. Lee vs. Lee's Air Farming. Company can enter contracts with directors acting as employees. 6. Exam tip. Always link with corporate personality and separate legal entity. 7. Practical tip. Company should maintain proper authorized signatories for litigation. 8. Can file appeals in NCLT and CLAT. 9. Legal notices must be served on registered office or ROC. 10. Insurance may cover liabilities arising from legal suits. 10. Limited liability. 1. Shareholders' liability limited to amount unpaid on shares. 2. Protects personal assets of members from company debts. 3. Exceptions. Fraud. Personal guarantee. Improper corporate bail lifting. 4. Case law. Guilford Motor vs. Horn. Liability may extend if company used for fraud. 5. Exam tip. Distinguish general limited liability versus exceptions. 6. Directors have duties under Companies Act. Failure may attract personal liability. 7. Liability is joint and several for Company Acts if statute provides. 8. Protects minority shareholders from over-leveraging. 9. Practical tip. Always check loan agreements and guarantees. 10. MCA may penalize directors under sections 447. 450 for fraud beyond limited liability. 11. Contractual rights. 1. Company can enter contracts in its own name. 2. Contracts may be with individuals, firms, or government. 3. Governed by Companies Act, Contract Act, and MOA AOA. 12. Types of registered companies. 1. Private company. Section 268, Companies Act, 2013. 2. Public company. Section 271. 3. Small company. Section 285. 4. One-person company OPC. Section 262. 5. Holding parent company. Section 246. 6. Subsidiary company. Section 287. 7. Associate company. Section 26. 8. Dormant and active company. Section 455. 9. Government company. Section 245. 10. Exam tip. No section numbers, definitions, membership requirements, and share transfer rules. 13. Private company. Characteristics of private limited company. 1. Minimum 2 members, maximum 200 members. 2. Restriction on transfer of shares. Cannot transfer freely without board member approval. 3. Cannot invite public to subscribe shares. 4. Can be incorporated with 2 directors minimum. 5. No requirement for minimum paid-up capital Companies Act, 2013. 6. Can enjoy exemptions under Companies Act. Exemption from holding AGM. Reduced number of board meetings. Relaxed filing requirement 7. Liability of members is limited to their contribution. 8. Name must end with private limited. 9. Process of incorporation. Reserve name through RUN 2 working days. File SPICE Plus. Obtained in, PAN, TAN. Certificate of incorporation issued within 2-3 days. 10. Exam tip. Focus on membership limits, share transfer restrictions, and exemptions. Case law. Rayfield vs. Hands 1960. Share transfer restrictions in private companies are valid if provided in articles. 14. Privileges and exemptions of private company. 1. Exemption from holding annual general meeting AGM if number of members less than 200. 2. Relaxed financial reporting requirements. Small company rules may apply. 3. No minimum number of directors, meetings restrictions as in public companies. 4. Can issue shares to a limited number of people privately. 5. Exemption from certain provisions of Sec 269 to 302 regarding appointment of key managerial personnel. 6. Can adopt simplified accounting standards under companies' accounting standards rules. 7. Audit exemptions available for small companies thresholds apply. 8. Reduced compliance burden under SEBI ROC filings. 9. Faster incorporation and approvals under MCA 21. 10. Exam tip. Focus on exemptions under Companies Act, 2013 for private companies. 15. Public company. Characteristics. 1. Minimum 7 members, no maximum limit. 2. Can invite public to subscribe shares. 3. Minimum 3 directors required. 4. Mandatory AGM and board meetings as per sections 96 and 173. 5. Liability of members limited to share contribution. 6. Must comply with full disclosure and filing requirements. 7. Can issue prospectus and listed shares on stock exchange. 8. Name must end with limited. 9. Subject to strict regulatory oversight by SEBI and MCA. 10. Exam tip. Distinguish clearly from private companies in terms of membership, share transfer, and public invitation. 16. Distinction between private and public company. Feature. Private company. Public company. Minimum members. 2. 7. Maximum members. 200. No limit. Share transfer. Restricted. Freely transferable. Invitation to public. Not allowed. Allowed. Exemptions. Yes. No. Name requirement. Private limited. Limited. AGM requirement. Not mandatory. Mandatory. Board meetings. Less frequent. Mandatory. Listing. Not listed. Can be listed on stock exchange. Exam tip. Highlight share transfer and exemptions. Focus on public access and compliance. 17. Small company section 285. 1. Excludes public company, holding company, or subsidiary. 2. Paid up capital is less than or equal to 2 crore rupees. 3. Turnover is less than or equal to 20 crore rupees. 4. Simplified annual filing and accounting requirements. 5. Reduced auditing standards. 6. Fewer compliance obligations under Companies Act, 2013. 7. Faster incorporation via SPICE Plus. 8. Directors, meetings minimum 1 per year. 9. Exam tip. Key point. Capital and turnover thresholds and exemption benefits. 10. Case law. NA. But relevant for exam MCQs on compliance relaxations. 18. Holding company parent company. 1. Holds more than 50% of shares or voting rights in another company. 2. Has control over subsidiary management. 3. Required to consolidate financial statements with subsidiaries. 4. Cannot escape liability for subsidiary frauds if act amounts to lifting corporate veil. 5. Must disclose shareholding and control in annual return. 6. Exam tip. Key sections. 246, 129-3. Consolidated financial statements. 7. Can exercise board control and appoint directors in subsidiary. 8. MCA 21 requires filing of holding subsidiary relationships in AOC 4. 9. Penalty for non-disclosure. Fine on company and officers. 10. Case law. CITV, Bombay Suburban Electric Supply 1962. Parent company liable for subsidiaries' actions in certain cases. 19. Subsidiary company. 1. Controlled by holding company via majority shareholding or voting rights. 2. Cannot act independently against holding company control. 3. Directors may be appointed by holding company. 4. Must file accounts and returns as per Companies Act. 5. Financial statements may be consolidated with parent company. 6. Exam tip. Differentiate subsidiary from associate less than 50% voting rights. 7. MCA 21 filings include AOC 4, MGT 7, and Forms CHG for charges. 8. Non-compliance attracts penalties under Sections 99, 450. 9. Liability of subsidiary is limited, except under lifting corporate veil fraud. 10. Case law. Prest vs. Petroleum Resources Limited 2013, UK. Corporate veil pierced to reach assets of subsidiary. 20. Associate Company Section 2, 6.1. One company exercises significant influence is greater than or equal to 20% shareholding but is less than or equal to 50% in another. 2. Not a subsidiary. Cannot control management. 3. Significant influence includes participation in policy and decision making. 4. Must disclose relationship in financial statements. 5. Exam tip. Focus on 20-50% shareholding range and significant influence. 6. MCA 21 filings should reflect associate companies in AOC 4. 7. Liability. Limited to its shareholding. Parent company not liable. 8. Can appoint representative director on associate company's board. 9. Accounting. Equity method for share of profits losses. 10. Case law. Singh vs. Union of India 2002. Exam relevance for ownership influence threshold. 21. Dormant and active company section 455. 1. Registered but not carrying active business operations. 2. Can be dormant to hold assets, intellectual property, or to restructure later. 3. MCA approval required filing form MSC 1. 4. Must declare annual filings as dormant company. 5. Exempt from tax and operational compliance unless activated. 6. Exam tip. Focus on purpose and registration process. 7. Can be reactivated on filing form INC 22A other prescribed forms. 8. Penalty for misuse. Company and officers may face fine up to 50,000 rupees. 9. Useful for investment holding or restructuring purposes. 10. Case law. NA. Primarily procedural and regulatory. 22. Government Company Section 245. 1. At least 51% of paid-up share capital held by government. 2. Can be central, state, or joint government ownership. 3. Governed by Companies Act, 2013, except where exempted. 4. Directors may include government nominees. 5. AGM, board meetings, and filing compliance mandatory. 6. Audit. Must follow CAG audit besides statutory audit. 7. Exam tip. Key point. Greater than 51% government shareholding. 8. Liability limited to shareholding unless fraud committed. 9. MCA filings similar to other public companies AOC 4, MGT 7. 10. Case law. Union of India vs. Tata Sons Limited. Government shareholding and control considered in legal interpretation. Key case laws. 1. Solomon vs. Solomon and Company, 1897. Corporate personality and limited liability. 2. Rayfield vs. Hands 1960. Restrictions on share transfer in private companies. 3. CITV, Bombay Suburban Electric Supply 1962. Parent holding company. Liability for subsidiary. 4. Prest vs. Petroleum Resources Limited 2013. Piercing the corporate veil applicable to holding subsidiary associate companies. 5. Singh vs. Union of India 2002. Significant influence in associate companies. Exam tips. Distinguish clearly between private versus public, small, OPC, holding, subsidiary, associate, dormant, government companies. Remember minimum and maximum membership, minimum directors, share transfer rules, and exemptions. Memorize section numbers e.g. Private company. Sec 268, public. Sec 271, small. Sec 285, OPC. Sec 262, no privileges exemptions of private companies. AGM, board meetings, simplified filings. Focus on liability of members, corporate personality, perpetual succession, separate property. Be able to give examples of doctrines in real-life company situations. Lesson 3. Memorandum and Articles of Association. 1. Memorandum of Association MOA. 1. MOA is the fundamental document of a company, defines its constitution, powers, and objectives. 2. Section 256, Companies Act 2013 defines MOA as a document that contains the constitution and scope of the company's activities. 3. It binds the company and its members. Doctrine of ultra vires applies. 4. Must be filed with the Registrar of Companies ROC during incorporation. 5. Contains name, registered office, objects, liability, capital, and subscription clauses. 6. Alteration requires special or ordinary resolution depending on clause type. 7. Exam tip. Always remember MOA defines scope of powers, while AOA defines internal management rules. 8. Penalty for non-filing or incorrect filing. Fine on company 100,000 rupees and officers 25,000 rupees. 9. Doctrine of ultra vires applies. Acts beyond MOA are void. 10. Case law. Ashbury Railway Carriage and Iron Company, Limited vs. Riche 1875. Company cannot act beyond objects in MOA. 2. Form of Memorandum of Association. 1. Table of format recommended, but now SPICE Plus filing includes MOA in electronic form. 2. Must include name clause, registered office clause, object clause, liability clause, capital clause, subscription clause. 3. Signed by minimum subscribers. 2 for private, 7 for public. 4. File with ROC along with SPICE Plus incorporation form. 5. Exam tip. Remember clauses in alphabetical and logical sequence. 6. Filing fees based on authorized capital, e.g. 1,000 rupees for up to 1 lakh rupees. 7. Certificate of incorporation issued after ROC verification. Usually 2-3 working days. 8. Pre-certification, DSC and DIN for subscribers required. 9. Changes post-incorporation require alteration procedures. 10. Case law. Ashbury Railway. Objects clause strictly interpreted. Exceeding powers void. 3. Contents of memorandum. 1. Name clause. Unique, must end with limited or private limited. 2. Registered office clause. State an address where ROC jurisdiction applies. 3. Object clause. Main objects, ancillary objects, and incidental objects. 4. Liability clause. Limited or unlimited, defines extent of members' liability. 5. Capital clause. Authorized capital, division into shares, nominal value per share. 6. Subscription clause. Number of shares agreed to by subscribers and amount paid. 7. Must comply with Section 4, 5, 12, 13, Companies Act 2013. 8. Exam tip. Often asked. Which clause is mandatory for ultra vires doctrine? 9. Filing. MCA 21 with SPICE Plus e-form. Approval within 2-3 days. 10. Case law. Ashbury Railway. Acts outside object clause or ultra vires. 4. Alteration of Memorandum of Association MOA. A. Alteration of name clause. 1. Procedure. Board meeting right pointing arrow special resolution right pointing arrow approval of members. File form INC 24 for name change with ROC. 2. Name approval required via Run Reserve Unique Name Service. 2 working days. 3. Effect. New name becomes effective after ROC issues fresh certificate of incorporation. 4. Fees. 1,000 rupees plus stamp duty depending on state. 5. Specimen resolution. Resolve that the name of the company be changed to XYZ Private Limited and ROC be requested for approval. 6. Case law. Re-Indian Bank Limited. Change in name requires ROC sanction. 7. Exam tip. No 2 methods. Special resolution plus ROC filing. B. Alteration of registered office clause. 1. Within local limits of same city town. Board resolution sufficient. File form INC 22. 2. Outside local limits but within same state. Special resolution plus form INC 22 to ROC. 3. From one state to another. Special resolution plus NCLT approval plus form INC 23. 4. Fees. Nominal. Usually 1,000 rupees per form. 5. Post-ROC approval. Update MOA, AOA, bank, contracts, and PAN-TAN registrations. 6. Specimen resolution. Resolve that the registered office of the company be shifted from XYZ to ABC within the jurisdiction of ROC. 7. Timeframe. Within 30 days of special resolution filing. 8. Case law. Shanti Lal vs. Union of India. Compliance with ROC required for validity of change. C. Alteration of object clause. 1. Requires special resolution plus ROC approval. 2. File form MGT 7 annual return and AOC 4 for alteration reporting. 3. Fees. 1,000 rupees plus stamp duty based on capital. 4. Purpose. Expand, modify, or restrict business activities. 5. Must not be ultra vires the company's scope. 6. Specimen resolution. Resolve that clause 3 of MOA be altered to include new business activities XYZ. 7. Exam tip. Always link ultra vires doctrine with object clause. 8. Timeframe. Usually 30 days post special resolution to ROC filing. 9. Case law. Ashbury Railway. Ultra vires transactions are void. D. Alteration of liability clause. 1. Can increase or decrease liability. Board plus special resolution required. 2. File with form INC 23 if liability increased. 3. Specimen resolution. Resolve that clause IV of MOA relating to liability of members be altered from unlimited to limited liability. 4. Fees depend on capital. 5. Exam tip. No difference between limited and unlimited liability alteration procedures. E. Alteration of capital clause section 61 and 64. 1. Increase in authorized capital. Board plus special resolution plus ROC filing form SH7. 2. Decrease in capital. Special resolution plus NCLT approval. 3. Registration. ROC issues fresh certificate of capital alteration. 4. Specimen resolution. Resolve that authorized capital of the company be increased from 1 crore rupees to 2 crore rupees and ROC be requested to register the alteration. 5. Fees. Based on increased capital. Nominal 1,000 rupees plus stamp duty. 6. Exam tip. Focus on SH7 filing, ROC registration, and NCLT approval for decrease. 5. Articles of Association AOA. 1. Defines internal rules and management of company. 2. Filed during incorporation. With ROC along with MOA. 3. Must comply with Table F for default rules unless customized. 4. Entrenchment provisions. Certain rules cannot be altered by simple resolution if entrenched. 5. Contents. Share capital rules, director powers, meetings, dividend policy, voting rights. 6. Distinction from MOA. MOA equals constitution and objects. AOA equals internal governance. 7. Legal effect. AOA binds company and members. Cannot contradict MOA. 8. Alteration of AOA. Special resolution plus ROC filing form MGT7 or SH8. 9. Limitations. Cannot contradict Companies Act, MOA, or public interest. 10. Case law. Royal British Bank vs. Turquand 1856. Indoor management doctrine protects internal procedural irregularities if third parties act in good faith. 6. Incorporation contracts and pre-incorporation contracts. 1. Pre-incorporation contracts are entered by promoters before registration. 2. Company is not yet a legal entity. Promoters are personally liable unless adopted post-incorporation. 3. Adoption by company. Board resolution plus ratification. 4. Specimen resolution. Resolved that the company ratifies all contracts entered into by promoters before incorporation. 5. Filing. Not mandatory, but maintain records for ROC inspection. 6. Case law. Kellner vs. Baxter 1866. Promoter personally liable for pre-incorporation contracts. 7. Exam tip. No promoter liability, adoption process, and resolution requirements. 8. Pre-incorporation contracts often include lease agreements, purchase orders, or service agreements. 9. Practical tip. Always attach ratified contracts during post-incorporation filing. 10. MCA 21 filing. Maintain minutes of board meetings adopting pre-incorporation contracts. Key case laws. 1. Ashbury Railway Carriage and Iron Company vs. Riche 1875. Ultra Vires acts are void. 2. Royal British Bank vs. Turquand 1856. Doctrine of indoor management protects outsiders. 3. Kellner vs. Baxter 1866. Promoters personally liable for pre-incorporation contracts. 4. Re-Indian Bank Limited. ROC approval needed for name change. Exam tips. 1. Memorize all MOA clauses and their alteration procedures. 2. Remember forms and filing numbers. INC 22, INC 24, SH7, MGT 7, SH8. 3. Link alteration clauses with type of resolution required. Ordinary versus special. 4. No timeframes, usually 30 days for ROC filing post-resolution. 5. Fees. 1,000 rupees nominal plus stamp duty where applicable. 6. Always relate ultra vires doctrine with object clause alterations. 7. Distinguish clearly. MOA versus AOA. Constitution versus internal rules. 8. Always mention case laws for doctrine explanation and theory answers. Lesson 4. Shares and share capital. Part A. Meaning and types of share capital. 1. Meaning and definition of capital. 1. Capital equals funds raised by a company from members shareholders for business purposes. 2. Section 28, Companies Act 2013 defines share capital as capital raised by issuing shares. 3. Forms basis of liability for shareholders in case of liquidation. 4. Share capital can be divided into equity shares and preference shares. 5. Essential for capital structure planning and financial management. 6. Exam tip. Differentiate share capital versus borrowing capital debt. 2. Types of share capital. 1. Authorized capital. Maximum capital company can raise stated in MOA. 2. Issued capital. Portion of authorized capital offered to shareholders. 3. Subscribed capital. Portion subscribed by members. 4. Paid up capital. Actually paid by shareholders. 5. Called up capital. Portion of shares called for payment. 6. Uncalled capital. Remaining unpaid portion. 7. Reserve capital. Called only on winding up. 8. Exam tip. Be able to draw flowchart from authorized right pointing arrow issued right pointing arrow subscribed right pointing arrow paid UP. 3. Compliance for publication of share capital. 1. File form SH1 SH7 with ROC for share allotment or alteration of capital. 2. Must disclose in prospectus or private placement offer. 3. Penalty for non-compliance. Company 100,000 rupees plus officers 25,000 rupees. 4. Time frame. Within 30 days of allotment or alteration. 5. Exam tip. No forms, sections, and penalties. Part B. Basic terms related to issue and allotment of securities. 1. Definition and meaning of securities. 1. Securities equals shares, debentures, or any other instruments of a company carrying rights of ownership or debt. 2. Defined under Sec 281, Companies Act 2013. 3. Includes equity shares, preference shares, debentures, bonds. 4. Exam tip. Remember equity equals ownership, preference equals fixed return, debenture equals debt. 2. Prospectus. 1. Document issued for inviting subscription for shares or debentures. 2. Section 270 and 26. Prospectus must contain material facts. 3. Types. Red herring prospectus. Shelf prospectus. Abridged prospectus. Deemed prospectus. 4. Liability for misstatement. Sec 34. Civil and criminal. 5. Case law. Greenhouse Company Limited vs. Royal Bank of Scotland UK. Misstatement in prospectus attracts liability. 6. Filing. With ROC, SEBI if listed, before public issue. 7. Penalty. Company 500,000 rupees plus officers 100,000 rupees. 8. Exam tip. No types and liability clauses. 3. Share certificate. 1. Section 46. Certificate issued to shareholder evidencing ownership. 2. Contents. Name of company, shareholder, number and class of shares, signature of directors CS. 3. Time frame. Within 2 months of allotment. 4. Loss of certificate right pointing arrow apply for duplicate certificate. 5. Legal effect. Evidence of membership and ownership. 6. Case law. Bhavesh G. Shah vs. Union of India. Share certificate is prima facie evidence of ownership. 7. Exam tip. Note time frame 2 months and legal significance. Part C. Issue and allotment of securities. 1. Kinds of issue of shares. 1. Public issue, offered to general public via prospectus. 2. Private placement, limited to select persons, Sec 42 compliance. 3. Right issue, existing shareholders get preferential rights. 4. Bonus shares, issued from reserves to existing shareholders. 5. Preferential allotment, specific investors get shares. 6. Employee stock option scheme ESOP, employees allotted shares at discount or exercise price. 7. Sweat equity shares, issued to employees for expertise, Sec 54. 8. Fees and forms, Spice Plus, PAS 3, SH 7. Penalties for non-compliance, 100,000 rupees plus officer 25,000 rupees. 9. Exam tip. No types, sections, and conditions. 2. Share premium. 1. Must be credited to securities premium account SPA. 2. Usage restricted under Sec 52. Issue of bonus shares, buyback, writing off expenses, providing for premium on redemption. 3. Cannot be used for dividends. 4. Exam tip. Remember SPA uses only as per law. 3. Allotment of securities. 1. Process. Application right pointing arrow board approval right pointing arrow issue allotment letter right pointing arrow update register of members. 2. Time frame. Within 60 days from receipt of application. 3. Section 39. Refunds due if not allotted within 30 days. 4. Penalty. Fine on company and officers 25,000 rupees each. 5. Exam tip. Remember time limits. 4. Private placement of shares. 1. Section 42. Offer to selected individuals, not public. 2. File PAS 4 with ROC. Minimum subscription amount must be received. 3. Time frame. 180 days for allotment. Excess must be refunded. 4. Penalty. Company. 500,000 rupees, officer. 100,000 rupees. 5. Exam tip. No forms PAS 4, PAS 3, limits and penalties. 5. Equity shares with differential voting rights DVR. 1. Section 43. Can issue DVR for startup companies or listed companies. 2. Voting rights can differ from normal shares. Max 74% voting rights for DVR. 3. Must be approved by shareholders via special resolution. 4. Case law. A CC Bank DVR shareholders case. Rights attached to DVR cannot be altered without approval. 5. Exam tip. No conditions and max voting rights. 6. Issue and redemption of preference shares. 1. Sec 55. Can issue redeemable preference shares. 2. Redemption. From profits or fresh issue. Must follow articles. 3. Procedure. Special resolution right pointing arrow ROC filing right pointing arrow redemption within time limit usually 5 years from issue. 4. Fees. Nominal plus stamp duty depending on capital. 5. Exam tip. Difference between redeemable versus non-redeemable preference shares. 7. Buyback of securities. 1. Sec 68. Company can buy back shares from surplus or securities premium. 2. Conditions. No default in repayment of deposits, outstanding debts, or liquidation proceedings. 3. Procedure. Special resolution if private company, board resolution if public company within 10% limit. 4. Prohibited. Default in loans, buyback funded by capital reduction. 5. Exam tip. Focus on source of funds, limits, and forms. 8. Reduction of share capital. 1. Sec 66. Reduction allowed only with NCLT sanction. 2. Can reduce paid up capital, shares, liability of members. 3. Procedure. Special resolution right pointing arrow NCLT approval right pointing arrow ROC registration. 4. Diminution of capital equals accounting adjustment, not reduction legally. 5. Penalty for non-compliance. 100,000 rupees company plus 25,000 rupees officer. Part E. Transferability of shares. 1. Transfer. Voluntary sale. Transmission. By operation of law death, inheritance. 2. Private company shares. Restricted by articles. Public company shares. Freely transferable. 3. Forms. SH4 transfer deed, update register of members. 4. Lost transfer deed. Can apply for duplicate via indemnity bond. 5. Shares to minors. Guardian acts on behalf. 6. Forged transfer. Void. Transposition allowed in cases of name correction. 7. Dematerialization. Physical shares right pointing arrow electronic form. Rematerialization. Electronic right pointing arrow physical. 8. Legal framework. Depositories Act, 1996. NSDL and CDSL. 9. Exam tip. No difference between transfer and transmission, process, and DEMA forms. Key case laws for Lesson 4. 1. Bhavesh G. Shah vs. Union of India. Share certificate is prima facie evidence of ownership. 2. Kellner vs. Baxter 1866. Promoters liable for pre-incorporation allotment. 3. A CC Bank DVR shareholders case. Rights of DVR cannot be altered without approval. 4. Ashbury Railway 1875. Ultra Vires issue of shares is void. 5. Rayfield vs. Hands 1960. Share transfer restrictions in private companies valid. Exam tips. Lesson 4. 1. Memorize types of capital and share capital flow. Authorized right pointing arrow issued right pointing arrow subscribed right pointing arrow paid up. 2. Remember time limits for allotment 60 days, refund 30 days, and ROC filing 30 days. 3. Forms to remember. Sh-1, SH4, SH3, PAS3, PAS4. 4. Differential voting rights, ESOPs, sweat equity right pointing arrow always mention conditions and max limits. 5. Buyback right pointing arrow source of funds and max percent right pointing arrow always compulsory to mention. 6. Private placement right pointing arrow section 42 plus PA forms plus penalties. 7. Transfer versus transmission right pointing arrow legal forms, Dormant procedure, and depository act. 8. Linked case laws to doctrines or practical example in theory answers for extra marks. Lesson 5. Members and shareholders. 1. The term members. 1. Defined under Section 255, Companies Act 2013. A member is a person whose name is entered in the register of members. 2. Members have rights to vote, dividends, inspect company records. 3. Can be individuals, corporations, or legal entities. 4. Membership is distinct from shareholding in companies not having share capital. 5. Case law. Solomon vs. Solomon and Company, 1897. Members are distinct from company. Liability limited to shares. 6. Exam tip. No difference between member versus shareholder. Very common in MCQs. 2. Ways to acquire membership of the company. 1. Subscription to Memorandum of Association. Original members at incorporation. 2. Allotment of shares. Via public issue, private placement, rights issue, bonus shares. 3. Transfer of shares. Voluntary transfer. Requires Form SH4 and update of register of members. 4. Transmission of shares. By operation of law death, inheritance. 5. Deemed membership. Articles or court order. 6. Time frame. Entries in register of members must be made within 30 days of allotment transfer. 7. Penalty for non-entry. 25,000 rupees on company and every officer in default Sec 94(3). 3. Differences between members and shareholders. Aspect. Member. Shareholder. Legal recognition. Must be in register of members. Ownership of shares only. Rights. Voting, dividend, inspection. Economic rights. Dividend, bonus. Non-share capital company. Can be member. N.A. Example. NGO board member. Equity shareholder of company. Exam tip. Be ready to draw a table of differences in exams. Often used for short notes. 4. Who may become a member? 1. Any individual or corporate entity capable of entering a contract. 2. Must subscribe to MOA or acquire shares. 3. Minor can become member through guardian, but cannot vote. 4. Company may restrict membership via articles private companies. 5. Disqualifications. Insolvent, unfit by law, or disqualified director Sec 164. 5. Minimum number of members. 1. Private company. Minimum 2, maximum 200 members Sec 268, 31C. 2. Public company. Minimum 7 members Sec 31B. 3. One-person company OPC. Single member sufficient Sec 31C. 4. Case law. Reed Pollock Limited. Company invalid if below statutory minimum members. 5. Exam tip. Always remember numbers for OPC, private, and public companies. Common MCQ topic. 6. Cessation of membership. 1. Death, insolvency, winding up of member. 2. Transfer or transmission of shares. 3. Non-payment of calls within prescribed time usually 30 days plus notice. 4. Expulsion under articles. Must follow due process. 5. Exam tip. Link with register of members updating. 7. Register of members. 1. Mandatory under Section 88, Companies Act 2013. 2. Contents. Name, address, date of becoming member, shares held, date of cessation, other particulars. 3. Form MGT7. Annual return includes members' details. 4. Time frame. Must update within 30 days of any change. 5. Penalty. Company. 25,000 rupees. Officer in default. 25,000 rupees. 6. Exam tip. No forms, sections, and purpose of register. 8. Contents of register of members non-share capital company. 1. Name and address of members. 2. Date of becoming member. 3. Date of cessation. 4. Number of votes if applicable. 5. Amount of subscription paid. 6. Exam tip. Difference between register for share capital versus non-share capital companies. 9. Maintaining register of members. 1. Can be physical or electronic Sec 88(1). 2. Authentication by CS or authorized officer. 3. Index of members. To locate names quickly. 4. Foreign register. If company has members outside India Sec 88(5). 5. Closing of register. For dividend or AGM purposes. Usually 15. 21 days. 6. Preservation. 10 years from cessation Sec 88(10). 10. Significant beneficial owners SBOs. 1. Definition. Person holding greater than 10% shares or voting rights indirectly Sec 90. 2. Declaration to company within 30 days of becoming SBO. 3. Company must maintain register of SBOs. 4. Consequences of non-reporting. Fine 25,000 rupees. Officer. 25,000 rupees. 5. Exam tip. SBO rules important for corporate governance MCQs. 11. Voting rights of members 1. Typically 1 vote per share, unless DVR. 2. Methods. Poll, show of hands, electronic voting. 3. Members can exercise voting in person or by proxy. 4. Exam tip. Be aware of voting rights in private, public, and OPC. 12. Rights of dissenting shareholders. 1. Right to exit or get fair value in cases like merger, takeover Sec 236. 243, Companies Act. 2. Protection against coercion or dilution of rights. 3. Case law. CITV, Bombay Suburban Electric Supply, minority rights to dissent recognized. 4. Exam tip. Link with shareholders' democracy. 13. Shareholders' democracy. 1. Major decisions require special or ordinary resolutions. 2. Businesses requiring shareholder approval. Alteration of MOAWA. Buyback of shares. Issue of sweat equity ASOP. Merger amalgamation. Variation of rights. 3. Exam tip. Memorize decisions requiring special resolution versus ordinary resolution. 14. Variation of shareholders' rights. 1. Rights can be varied by articles or shareholder consent. 2. Requires special resolution if affecting preference shareholders. 3. Case law. Allen vs. Gold Reefs of West Africa. Variation valid if done bona fide in interest of company. 4. Exam tip. Understand procedure, sections, and legal protection. 15. Liability of members. 1. Limited to nominal value of shares held Sec 49, Sec 43. 2. Exceptions. Personal guarantee, fraudulent trading, ultra vires acts. 3. Exam tip. Link liability with Solomon case and limited liability doctrine. 16. Shareholders agreement and veto rights. 1. Shareholders agreement. Defines rights, obligations, exit strategies, voting, veto powers. 2. Veto power equals blocking certain decisions. Casting vote equals deciding tie-in meetings. 3. Assignment of shares. Must comply with articles plus Sec 58 transfer rules. 4. Exam tip. Be able to differentiate veto versus casting vote. Often asked in scenario questions. Key case laws. Lesson 5. 1. Solomon vs. Solomon and Company, 1897. Members distinct from company. Limited liability. 2. Reed Pollock Limited. Minimum statutory members required for validity. 3. Allen vs. Gold Reefs of West Africa 1900. Variation of rights must be bona fide. 4. CITV, Bombay Suburban Electric Supply. Minority shareholder rights recognized. Exam tips. Lesson 5. 1. Memorize sections. 255, 88, 90, 42, 58, 164. 2. No minimum number of members for OPC, private, public companies. 3. Understand SVO rules, timelines for declaration, and penalties. 4. Be ready to differentiate. Transfer versus transmission, veto versus casting vote. 5. Keep key case laws and doctrines handy for theory questions. 6. Be aware of forms for registers MGT7, SH4, etc. and filing deadlines. Lesson 6. Debt instruments. Concepts. Part A. Borrowing powers of company and debt capital. 1. Borrowing powers of a company. 1. Section 181C. Board can borrow money beyond paid-up capital and free reserves only with special resolution of shareholders. 2. Borrowing limit as per articles or special resolution. Excess equals ultra vires. 3. Borrowing can be from banks, financial institutions, public issue, private placement. 4. Borrowing decision documented in board resolution. 5. Case law. Ashbury Railway vs. Reach 1875. Borrowing beyond objects of MOA equals ultra vires. 6. Exam tip. Link borrowing powers with ultra vires doctrine. Often asked in MCQs. 2. Types of borrowings. 1. Debentures. Secured unsecured debt instrument. 2. Bonds. Typically issued to institutional investors. Long-term. 3. Bank loans. Short medium-term loans from banks. 4. Public deposits. Acceptance from members public under Sec 73. 76. 5. Intercorporate loans. Borrowing from other companies. 6. Exam tip. Be able to distinguish debenture, bond, bank loan. 3. Debentures and bonds. 1. Debenture. A document acknowledging debt. Sec 230. 2. Bonds. Issued usually in denominations, tradable, can be bearer or registered. 3. Debenture holders equals creditors, no ownership rights. 4. Issue requires board resolution, debenture trustee if public. 5. Exam tip. Remember debenture equals secured unsecured. Bond equals long-term institutional. 4. Difference between bonds and debentures. Aspect. Debenture. Bond. Issuer. Company. Government company. Tradable. Registered bearer. Mostly bearer. Security. Secured unsecured. Usually secured. Holders. Creditors. Creditors investors. Returns. Fixed interest. Fixed interest. 5. Kinds of debentures. 1. Secured versus unsecured. 2. Convertible versus non-convertible. 3. Redeemable versus irredeemable perpetual. 4. Registered versus bearer. 5. Partly convertible. Some portion converts into equity. 6. Zero coupon debentures. No periodic interest. Issued at discount. 7. Exam tip. No types, examples, and section Sec 71. 74. 6. Conversion of debentures into shares. 1. Convertible debentures. Section 55 and Articles of Association govern conversion. 2. Time frame and ratio must be stated in prospectus offer letter. 3. Conversion requires board resolution plus update register of members plus ROC filing form PAS 3. 4. Case law. Bhavesh G. Shah vs. Union of India. Conversion requires proper compliance with articles and terms. 7. Debenture redemption reserve DRR. 1. Mandatory for listed companies banks before redeeming debentures Sec 71 4. 2. Minimum 25% of debenture value to be kept aside in DRR. 3. Cannot be used for dividend. Only for redemption. 4. Exam tip. No DRR percentage, usage, and penalties. 8. Debenture trustees and trustee. 1. Sec 72. Trustee appointed to protect debenture holders. 2. Trust deed contains rights of holders, repayment schedule, security, covenants. 3. Filing with ROC. Not mandatory but compliance with SEBI for listed company. 4. Duties. Monitor company's performance, security enforcement. 5. Penalty for non-compliance. 25,000 rupees company and officer. Part B. Overview of company deposits. 1. Meaning of eligible company. 1. Sec 231 and 73(2). Eligible company. Public company other than banking company having net worth greater than 100 lakh rupees or turnover greater than 500 lakh rupees. 2. Exam tip. No criteria to accept deposits from members public. 2. Terms and conditions for acceptance of deposits Sec 73(2). 1. Only from members unless company meets Sec 76 conditions. 2. Must issue circular advertisement in prescribed form. 3. Deposit must be repayable within 36 months unless otherwise permitted. 4. Interest must not exceed permissible limits as per RBI SEBI. 5. Penalty for contravention. 25 lakh rupees and officers 5 lakh rupees. 6. Exam tip. Remember forms CHG 7, DPT 3 and time limits. 3. Acceptance based on time period. 1. Short-term deposits. Less than 12 months 2. Medium-term deposits. 12. 36 months 3. Long-term deposits. Greater than 36 months require special approvals. 4. Deposit must mature as per terms. Premature repayment subject to articles. 4. Acceptance limits for deposits. 1. Cannot exceed 25% of paid-up share capital plus free reserves Sec 73(2). 2. Filing DPT 3 with ROC within 30 days of receipt. 3. Exam tip. No limits, ROC filing, and penalties. 5. Repayment of deposits. 1. Repayment on maturity or premature as per articles. 2. Maintain deposit repayment reserve account for repayment. 3. Default right pointing arrow company liable under Sec 76 and 447 fraud. 4. Penalty. Company, 25 lakh rupees. Officer, 5 lakh rupees. 6. Trustee for depositors. 1. Only eligible for companies with public deposits. 2. Duties. Monitor company compliance, protect depositors' interest. 3. Case law. Industrial Credit and Investment Corporation vs. Debenture holders. Trustees liable for negligence. 7. Meetings of depositors. 1. Sec 74. Mandatory for alteration in terms of deposit. 2. Convened by company or trustee. Quorum as per articles. 3. Exam tip. No quorum, agenda, and reporting. 8. Deposit receipts and liquid assets. 1. Furnish receipts with terms of deposit, interest rate, maturity. 2. Maintain liquid assets minimum 20% of deposits Sec 73(2)(c). 3. Create deposit repayment reserve account DRRA. 4. Exam tip. Link DRRA and DRR debenture differences. 9. Registers of deposits. 1. Maintain register of deposits. Form DPT 2. 2. Contents. Name, address, deposit amount, interest, maturity, repayment status. 3. Closing and preservation. 10 years. 4. ROC filing. DPT 3 annually. 5. Penalty. Company 25,000 rupees. Officer 5,000 rupees. 10. Premature repayment of deposits. 1. Allowed only as per articles or consent of depositors. 2. Report to ROC via DPT 3. 3. Interest recalculated at reduced rate. 4. Exam tip. Remember premature repayment rules. Common MCQ topic. 11. Disclosures in financial statement. 1. Sec 73 and 102. Deposits shown separately under liabilities. 2. DRR, DRRA, overdue deposits must be disclosed. 3. Auditor confirms compliance in audit report. Key case laws. Lesson 6. 1. Ashbury Railway vs. Riche 1875. Borrowing beyond MOA equals ultra vires. 2. Bhavesh G. Shah vs. Union of India. Compliance for debenture conversion mandatory. 3. Industrial Credit and Investment Corp vs. Debenture holders. Trustee liable for negligence. 4. Rayfield vs. Hands 1960. Share transfer restrictions affect debenture security indirectly. Exam tips. Lesson 6. 1. Memorize sections. 71. 76, 181C, 73. 74, 90. 2. No types of borrowings, debentures, bonds, DRR, DRRA. 3. Forms. PA 3, CHG 7, DPT 2, DPT 3. Always remember for MCQs. 4. Timeframes. Debenture allotment right pointing arrow 60 days, deposits filing right pointing arrow 30 days. 5. Link borrowings with ultra vires doctrine for theory questions. 6. Differentiate DRR debenture versus DRRA deposits. Common exam trap.